Welcome to this YouTube channel on how to buy a business no cash down. I'm Carl Allen and I've been buying businesses now for almost 25 years, more than 250 deals in 17 different countries. So this playlist is all about deal making basics, the fundamental rules of what we do to take over someone else's established business without spending our own money. Here's the next video in the sequence. There are 6 in total.
Next, let's discuss time-starved investors, and here I'm covering venture capital investors. Now, all investors are in the business of overall returns, and for that, not all investments need to be successful. I've worked in the venture capital space and know a lot about this market. Now, I'm using all these examples as extremes: Google, YouTube, Apple, Facebook, Pastini, etc., as big returns for investors to prove the point. But this goes on in every investment fund on the planet. If you've made 10 investments over a 3 to 5 year period and you've got one big home run like a Facebook, then why would you care about all the other investments that are just ticking along? Well, that's the point. They don't, and we can take them off their hands for nothing. At least 50% of venture capital investments get neglected and they are eventually either written off or given up. So why do investors give up on these businesses? They may not be a Facebook or a Google, but most of them will still be great business opportunities. And the answer is simple: it's time. Now, investors do 4 things. The first thing they do is go out and raise money. This is from high net worth individuals, pension funds, insurance companies, banks and large businesses. That money is what gets invested in deals. The second thing they do, once they've got that money, is they've got to go and make investments. Now, it's really time consuming to make these investments. And as we mentioned earlier, some of them are going to be startups and they're very risky. So an investor has to do a ton of due diligence to make sure that the business has got at least some chance of being in the 4% that survive. The third thing an investor does is it has to support all the investments it makes during ownership, and this can take up to 75% of their total time. When I worked in venture capital, at least 3 days per week of my time was spent working with portfolio companies, helping hire management, setting strategy, reviewing financials, helping with marketing, operations, everything. There just isn't enough time in the day to support all the businesses you've invested in. And then the fourth thing they do is they have to sell the investments. They sell the better businesses that they've bought into. So if you're continually raising new capital, making investments and selling them, you just run out of time to support every business in the fund. And that's what we're going to exploit. So how does this work? Let's look at a quick example to bring this to life. So let's take a fund that raises, say, $9 million from all those different investors we talked about before. Now, typically, up to 10% of all the money raised goes on fees and costs in running the fund. So let's say that's a $1 million charge. That leaves $8 million. So let's go and make 8 $1 million investments. And let's say deal 1 is the big home run. It's not necessarily a Google, as that generated more than 500 times return for the early investors. Most funds, however, have got one deal that generates a 50x return. And then let's say deal 2 is a burger bar and generates a much smaller return, just over 3x. And deal 3 is a manufacturing business and the investor doubles his or her money. And finally, deal 4 was an investment in a music studio and the fund only just got its money back with little or no profit. Now, deals 5 through 8 were either written off or given away. All the time was spent on the first 4 deals, the vast majority on the big home run, making them, supporting them, selling them. Deals 5 to 8 just didn't get a look in, but are still good businesses. Now, overall, the $8 million invested generated a $56 million return, which is a $48 million profit. Most of the profit came from those first 2 deals, the vast majority from the 50 times return. Now, I'm showing you this to illustrate what really drives venture capital investors. You don't need to understand the maths here, but this is all about internal rate of return, IRR. This is the scorecard that dominates the investor market, and it's what they use to go out and raise more money from investors. So it's like their track record, their scorecard. Now, in our example, the fund generated a 29.3% IRR. So the investment, what that means is it compounded its growth at 29.3% every year. So it started off at 8 million, and if you multiply 8 million up by 29.3% every year for 7 years, which was the lifetime of the fund, it ends up then being $56.4 million. For all your maths professors out there, the formula's up there highlighted in yellow. You don't need to understand it. It's a compounded growth formula. Now 29.3% is a great result, yet 50% of the businesses were given away and written off. That's why investors focus on the biggest opportunities and ignore the rest. So who wants these businesses? Well, we do. Those are the deals that we want, and my system finds them. It's just too time consuming supporting all of the businesses in a portfolio. Just going to board meetings can be a 3-day event. As I mentioned before, this is only one of the 4 jobs of an investor, but it can take 75% of the total time. Now, back in 2002, one fund I know dumped 750 of its businesses. It was a massive fund, and it had invested in 850 businesses over a 20-year period. A new chief exec came in, and his first action was to only focus on the top 100, his perceived top 100, and dump the rest. Now, some of these were amazing businesses and were literally given away to people like you and I. And one of these deals was later sold for more than $100 million, yet the fund was happy just to give this deal away before the business really took off. Now, sadly, I didn't own this business, but what if you got your hands on one of these businesses, applied your skills and your knowledge, and you grew it, and then you sold out to the highest bidder? Well, that is what this is all about. Now, just to put this into perspective, just look at how many opportunities there are in the USA alone. According to the Private Equity Growth Capital Council, there are almost 2,800 investment funds in the USA, and across these 2,800 funds, there are more than 17,000 investments or portfolio businesses. So applying that 50% rule, that's more than 8,500 opportunities on top of the hundreds of thousands or millions of owner-manager businesses that we discussed earlier. In the UK, the numbers are smaller, but 1,600 opportunities if you use the same math. So how do we find and approach them? We're going to cover that shortly in part 3. Now finally, the third seller type is the big business, the refocused or the changing big business. And what drives these bigger companies to dispose of non-core subsidiaries and how that benefits us? Why do they change strategy and focus on only big core divisions, thus neglecting many of the smaller ones which then become available to us? Now, some of you may work for really big businesses, so you'll understand this, but big businesses, they make acquisitions in bull markets when business is really, really great, and they do that to keep going. And they also make acquisitions in bear markets when business isn't so great and they want to diversify. They can pick up complementary businesses or competitors at a much cheaper price. Now, most big businesses, and you'll know if you work in one, they become masses and masses of sprawling divisions. Now, inevitably, things change. New CEO comes in, new chairman, new board, a whole new strategy, and all of these things happen all the time in big businesses, and then they need to focus on different things, and that may not include lots of these non-core sprawling masses of business units, and that's what generates opportunities for us. Now, I'm not saying all carve-outs are going to be free. If you are a $10 billion business and you have a $100 million subsidiary, then you're going to sell it for $100 million. But then why would you then spend a ton of time trying to then sell tens, if not hundreds, if not thousands of much smaller micro subsidiaries when they all take the same amount of time? Now, what's great for us is that all these non-core subsidiaries need a home, and I'm talking about $1 million to $20 million revenue subsidiaries that are neglected, they're unloved by the corporate management, they're ignored, and they just need a good home. So imagine that you have a dog, and for whatever reason you just can't care for it anymore. It's a great dog, you relocate, you change your lifestyle, you get sick, your partner has a baby, you need to remove the dog from the home. So what do? Do you have it put down? Well, probably not. Wouldn't it make you feel much better if you gave that dog away to a shelter or another person who can care for that dog? It's exactly the same for big businesses, it's exactly the same for time-starved investors, and it's exactly the same for burned-out owner-managers. Going back to big businesses, in these cases, a lot of what we discuss with owner-managers is still relevant. Big business would rather give a non-core subsidiary away to a good home than go through the hassle, the pain, and the cost of closing it down. Again, it can cost a lot of money to shut down a business, so giving it away saves the money. And we spoke before that competitors acquiring a business will fire employees to save money, and big businesses don't want the negative PR that will come for it. So in summary, the safe, trusted pair of hands is still very relevant for big business. However, we've discussed that some of the reasons are different than burned out owner managers or the investor, but some of the reasons are the same.
So that's it for this particular video. The next video in this playlist will follow, and please check out all the other playlists and videos for everything you need to know to learn how to buy a business no cash down. In fact, I've crammed everything that you need to know into a special 90-minute webinar titled 3 Insider Secrets to Buy a Profitable Business Inside of 99 Days Without Cash or Knowing How to Run a Business. And here are the 3 big secrets, the 3 killer training topics. Think of these as hurdles to you becoming a business owner. First, I'll show you exactly what the 10 steps are to buy a business, and you must follow these in order. It's really critical. Second, I'll show you lots of case studies of deals structured using OPM, other people's money, and it's no more difficult than high school math. And finally, I'll show you how you can get others to operate the businesses for you, so you can do other things like spend time with your family or buy other businesses whilst enjoying the cash flow that your new business is generating for you. So to register for this groundbreaking training, just click on the link underneath this video on YouTube or type in this link into your browser. And I'll see you on air sometime in the next week. Until then, bye for now.